This is the Real Estate Investing Abundance Podcast. I'm your host, Dr. Allen. I know you're excited to get into today's show, but I have a very exciting announcement to share with you before moving to the show. We've just launched a complimentary and comprehensive webinar that, among other things, shows you how to legally use passive real estate investing to reduce your taxes, recession-proof your nest egg, and take the sting out of inflation. If you're curious to learn more, go to stevetucker.com/webinar. It is complimentary and only takes a couple of minutes of your time. Once again, that is stevetucker.com/webinar. I'll see you in the webinar. Enjoy today's show. Hello, enlightened investors. Welcome back to Real Estate Investing Abundance. I'm your host, Dr. Allen, and I'm delighted to be back with you again today. We are fired up, and we're going to look at Firefighter, investing in real estate. Tim Lyons is the co-founder and managing partner of Cityside Capital, along with his brother Greg. He is a registered representative of Phase One Financial Services, a broker-dealer based in New York City. Tim is focused on raising capital for multifamily, self-storage, and industrial assets that provide great risk-adjusted returns, tax advantages, passive income, and equity upside. So, Tim, take us into the show and share a memorable experience that helped you to be who you are today.
Well, Alan, thank you for having me on the show. And a memorable experience is waking up at Providence College on September 11, 2001. And Providence College is in Rhode Island. I'm from New York City. And, I just knew that something bad had happened. I was going to know a lot of folks that were going to be impacted by that event. And I was right. And, that led me to becoming a New York City firefighter because I decided on that day that I was so inspired by what I saw on TV that I was going to become a New York City firefighter. And that's what I did.
Wow. I wonder how many people actually woke up on 9/11 and said, I'm going to be a firefighter. I suspect not very many. But anyway, so you started out in firefighting. So how did you get started into real estate from a firefighter perspective?
Yeah, so I'm blessed and grateful to be a part of the New York City Fire Department. I've been doing it for 18 years this month. And I have 2 years to go until I can maybe retire or maybe not. I don't know yet. But, when I walked in the front doors of the firehouse, Alan, a lot of guys and girls had second and third careers. They did HVAC, they did contracting, they owned bagel stores, tanning salons, you name it. And I probably ran into a firefighter that does it. And a few of them were nurses. They were registered nurses. They worked on the side in the hospitals and they had the nice cars in the parking lot. And I was pre-med for about 15 minutes back in college before I joined a fraternity and whatnot. So I said I could do this, So I went back to school, became a nurse, and I had 9 years in the emergency room of Level 1 Trauma Center. And it was awesome, right? I mean, I go from firefighting to the ER, never a dull moment, always a new thing to worry about. But during that time, I had 3 little girls who are now 12, 9, and 4 this weekend. And, when they were little, they didn't say anything, right? They didn't know any better. But when they got to be bigger and I wanted to coach their teams and my wife needed help, they started to feel it. I started to feel it. I, really quickly needed to get myself financially educated because I was realizing that I wasn't going to save my way to wealth. While I was grateful for the pension that awaits me when I retire, I knew it wasn't going to be enough to help me live today. So in my research, Alan, I basically realized that I needed equity. And what I came down to was either a business or real estate. I managed to find something where I can do both of those things at the same time. And I now have a company, Cityside Capital, that, invests in multifamily, self-storage, and industrial assets. To get started, though, I had to get educated. I got mentored, and then I took some action by basically investing in a 3-family, small multi, a triplex with a friend of mine, because I was scared to do it by myself. And I was scared to do a single family rental because I had this mental block. If somebody moved out, I would have 100%, vacancy. And that scared me. So at least with the 3 unit, I knew that if 2 of them were rented out, I could still cash flow just a little teeny tiny bit. And the third unit would be the profit. So that's how I got started. I started that in November of 19. I ended up selling that 3 unit in November of 21. I just kind of rode that COVID price wave. Realized that I hated being a landlord, even though I really wanted to do it. I wanted that experience. So in 2 years, I got it, and I moved on to commercial.
Well, interesting trajectory there from firefighter to nurse to financial acumen, and particularly in real estate. Well, how can we change our beliefs to get into real estate investing, no matter really essentially where we are or who we are?
That's a great question. It's all about mindset. And when I used to listen to these podcasts, Alan, when I first got started and I hear about mindset and personal growth and development, I'm like, why are all these real estate podcasts filled with personal development and mindset stuff? I just want to learn the X's and O's about landlording, right? And I wasn't ready to hear it at the time, in the beginning. I wasn't there yet. And, my dad always told us, one day you're going to hear the pop, right? And that was your head coming out of your rear end. And, I think I heard the pop, Alan. And, I started to get down this rabbit hole of education, reading books, audiobooks, podcasts, turn my car into the university on wheels. And what I started to see was, you have to have an open mindset, an abundance mindset. And I hadn't heard these terms, but I learned that I had a scarcity mindset. And that was rooted in, my modest upbringing. My 2 brothers, divorced parents, paycheck to paycheck, how it goes. And I think as an adult, I wasn't able to shake that, right? I couldn't see the forest for the trees. So taking that zoom out and working on myself, working on my mindset, realizing that I could do this type of thing, that I just wasn't, real estate wasn't for the rich and the wealthy and the 1%, what people talk about. That if you're defiantly committed to an outcome and you follow the steps that have been laid out before you, that you can be successful too. So once I really kind of got my head around that, it opened up my whole world. I retired from my nursing job, I like to say, February of 2020. So my coworkers always thank me that I left a month before COVID hit our shores. But, I had to go all in, and I believed in myself. I knew my work ethic was second to none. And I knew that if I really put my mind to it, that good things would happen. And, with that faith, the 3-family came, and then the 43 unit came, and then the 148 unit came. So that's how it started.
We have to start someplace. And I, like you, I get a little tired of hearing mindset in real estate time and time again. I think it is definitely an overused term, but it definitely is a concept that is of importance, and it does have meaning, and it really does make a difference how it is that we think and see ourselves, not only from an abundance perspective, but how we see ourselves as capable or incapable. Well, talk to us about traditional accumulation and deferred gratification versus building cash flow and passive income now.
Oh, Alan, you're asking me questions that I love to answer. So the delayed gratification, right, and the accumulation model, right? So growing up in a very modest household, I was taught along with my brothers to go to school, get good grades, right? Go find a job. And growing up in the New York City area, a lot of people always talk to us about getting a government job, right? Take the sanitation test, take the police department test, take the fire department test, take all the tests, right? Because they have pensions and they have guaranteed benefits, and that's the holy grail. And, that's what I kept on hearing from, people in the neighborhood or, extended friends and family. So that kind of contributed to my money mindset, right? All right, well, yeah, I'll go to school, I'll get good grades, I'll do all the things. I'll max out my 457 or 401k. I'll buy a house, right? And I'll try to pay it off early. And, then maybe when I accumulate all these paper assets, then when I'm in my 60s, Alan, I'll be able to start peeling it off at 4% a year and really start living, but hopefully my income is below the threshold that I have to pay a lot of taxes. So I'm going to try to retire poor. And, when I took a step back and I started thinking about it, I'm like, man, this does not make sense, right? I mean, I had dreams about winning the lottery or, coming into all this money, right? Because that would be the panacea that I was looking for as a young kid. And then I started to hear about cash flow, right? And I started to hear about income producing assets and the golden goose that lays a lot of good golden eggs, right? And when I finally got financially educated, and I said, well, listen, I don't need 5-10 million dollars at one clip. What I need is to start building out my cash flow on a monthly basis, really get in tune with my income and expenses. And if I'm able to build up enough monthly income that I don't have to work for, I don't have to work my overtime in the firehouse for, I don't have to go, be an active landlord for, then that's actually more of the freedom that I was looking for, because I want to live my life today. I want to live with my life with my little girls, because God knows, 12, 9, and 4, they're not getting any smaller or any younger. And, I think that realization hit me because, look, as a New York City firefighter, I don't want to make it like this drastic thing, but I've always worked in the busiest neighborhoods, go to a lot of fires, a lot of shootings, a lot of stabbings, a lot of bad stuff happens, right? And I've been there. And I like to be in the room. When things are going south, I want to be the guy in the room, whether it's in the emergency room or out in the field. But when you come home into a safer type of environment, it makes you really realize what's important and where I belong and the role model I want to be and the life I want to live.
Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. Well, Tim, you started out small with a triplex. Some people might not think that is small, but in terms of commercial real estate, it's a small start. But you moved from that pretty rapidly into larger commercial properties. Why did you start that way? And is that a good way to start? Does it make sense? How do you go from that small to larger propositions?
So the first house I bought with my friend Craig was $276,000. It was a 3-unit, and the taxes were $6,100, and I could cash flow it very nicely. And I said to myself, "Wow, like I'm going to buy 30 of these things and be on easy street." The problem, Alan, was that it was built in 1920, so were all the other houses around that area. Even though they had potential for great cash flow, there were also capex tsunamis waiting to happen. Mm-hmm. And I had to do a new roof, new siding, new air handlers, new hot water heaters. And that all adds up very quickly and can really torpedo cash flow in the beginning of a project. Luckily, we got the house at such a good basis that, doing those upgrades really helped us, command higher rents and hit the ground running. When I took a step back and I said, do I want to get involved in 1920 built properties, 100-year-old properties? And I just didn't want to, right? Mm-hmm. At the same time, this was an hour away from my home, because in the greater New York City area, it can be very challenging to cash flow. So I said to myself, I need to learn how to go bigger. So I ended up getting a mentor in multifamily. I wanted to learn the ropes. I wanted to learn the underwriting, because when I heard about underwriting and net operating income and cap rates and above the line and below the line, profit and loss statements, I mean, my head was spinning on podcasts and audiobooks. I didn't know what they were talking about. It seemed like a private equity guy with a suit on Wall Street was more apt to do this type of work than Tim Lyons, the firefighter ER nurse. But again, I was defiantly committed to learning it and understanding it. So I met with a mentor, and he ended up getting, after working with him for like 6 months, just kind of seeing what he was doing and seeing how his process worked. He had gone full cycle on 4 or 5 syndications and lived in New York, invested in Atlanta, Georgia. And all of a sudden he was going to move to Pennsylvania and with his family, and he couldn't sit still. So he looked at commercial properties while he's looking for a primary residence as well, and came up with a 43 unit in Pennsylvania. He invited me basically to join him on that deal. And I had a front row seat to due diligence, debt financing, insurance, and then capital raising at the end of the project. And he said to me, do you want to give capital raising a shot? And I said, Chris, man, like I don't know if I can bring $5 or 500 or 5 million. I have no idea what I can do for this, but don't count on me, right? I don't want the pressure. And basically armed with a Gmail account, no website, no automations, no fancy CRM, nothing. I just started to add people in my life, aunts, uncles, cousins, college roommates, neighbors, firefighters, all people who I thought had money and who might be interested in a deal like that. And I was able to raise $150,000 for my first deal. And that was my first inkling to say, wow, that was pretty powerful. And I could probably start a business around this if there's enough appetite for alternative type investments. So that's what I did. I started Cityside Capital with my brother Greg, and he's down in Virginia. And we have grown, from that first deal of August of 2020, right in the middle of COVID, to nearly $1.6 billion of by transactional amount of multifamily self-storage and industrial projects. It's been wild.
Well, that's an impressive growth rate there. So do you credit a lot of that to your mentor?
Well, yes. I mean, real estate, and I guess it's specifically multifamily, large multifamily, it could be really challenging to get into the game, right? Sometimes it's working for free, or sometimes it's paying for a mentor, or sometimes it's a family business and you kind of walk into it. But to come off the street and not have any experience, or not have an economics or a finance type background, or not be, handy, with due diligence and asset management and property management, it can be hard to get started. So for Chris to give me the opportunity to join him, to basically leverage his credibility into his deal was huge, but then to really add value by saying, look, I'm from the New York City area. I know some moneyed people, he pushed me out of my comfort zone. And that's what I needed, right? Because I don't think I would have done that if it wasn't for him to say, look, this is what you have to do. This is how I do it. Let's get them onto the webinar. Let's answer some questions, and if I didn't do that, because that was hard for me to do, I felt like I was asking people for money, where I've now learned that I'm offering them a deal, an opportunity to invest. And if they do it, great. If they don't, that's perfectly fine too. So yeah, I do credit him as, taking a chance on me, showing me the ropes. And that's what I've found in real estate, to be honest, Alan. A lot of business can have the appearance of being dog eat dog, and I've really found in real estate, specifically commercial real estate, that people that are just one ladder rung above me will lower their hand and try to pull me up to where they are, So I've tried to do that repeatedly now to people who I feel like I'm one rung ahead, to help them up too.
Yeah. Well, Tim, you have some things to offer our viewers and listeners. Tell us about that, and how can they take advantage of it?
So I actually wrote a chapter of a book called Bringing Value, Solving Problems, and Leaving a Legacy. It ended up being a #1 bestseller for about 5 minutes. So if you want to hear more about my story, I wrote it in that chapter. I'd be more than happy to send you a hard copy or an electronic copy. Just send me an email to tim@citysidecap.com. You can check out our podcast called the Passive Income Brothers Podcast on any of the major platforms. And, if you're interested in passively investing with your cash, retirement accounts, or 1031 exchanges, I'd be happy to hop on a call just to kind of talk you through what the options might be.
And all that information is in our show notes. Tim, what is the difference between active versus passive investing?
So I like to joke that I'm actively passive, Alan, because I get to see a lot of the deals come through and then I choose which ones I want to work. But really, active investing is, be going out there, getting the property under contract, whether it's a single family, duplex, triplex, quad, whatever it might be, self-storage facility, and then doing the due diligence, getting the debt financing, getting the insurance, under either you're doing the property management or you're getting a third-party property manager, negotiating terms, and then writing the business plan to completion. It could be another job, right? I can't stand sometimes when I see YouTube videos or podcasts talking about all this passive income in real estate. I learned very quickly with that triplex, there was no passive income until I had that machine running for about a year, at least. So yeah, I mean, it's active is very active, and you got to really commit to the process and treat it like a business. This is not something to me that can be just a side hustle that you kind of spend a little bit of time on because you're at risk to lose your shirt or a lot more. Passive investing, to me, had I known about it early on, I may have never even bought that 3-family property because I burned a lot of brain cells trying to get that thing, up off the ground. So for me, passive investing just means, look, you may not get the higher return with active investing, but if you're with a good operator that does monthly reporting, quarterly financials, they're transparent, they're in a vehicle that you like and understand. Like I can understand multifamily, Alan, right? People need a place, a food, clothing, and a place to live, right? I may not understand data centers or, the dynamics of supermarkets or open air retail as much as I do multifamily, right? So you find a vehicle that you like, an operator that you like in a market or submarket that you like and understand, as far as population growth and job growth and what kind of opportunities are available. And then, your hard part is over. Once you vet all those different variables, you invest your money, and then that's truly passive investing.
And yes, there are both opportunities in real estate investing. Well, you have done some capital investing and started out cold with really no background in that. So you've learned the ropes from the ground up. Take us through capital investing and what's involved, and what are some great suggestions for those starting out in capital investing?
So, really, I would start wherever you are, right? If you have a lot of money, then you can deploy into multiple different types of operators or markets or vehicles. If you don't have a lot of capital, but you want to just, get started, you can do single family, right? There's turnkey single family. There's single family that you can go out and get it under contract and do all the work with. If car washes are your thing, there's ways to do car washes, self-storage, industrial, triple net leases, there's so many things to do. It would really just behoove you to kind of see what people in your own network are doing. Real estate's one of those things that everybody kind of has on their mind, whether they've done it or not, because if they've done it, they're a great resource. And if they haven't done it, they probably think about it often. So comparing notes, hey, what works for you? Who have you worked with? What markets do you invest in or have you invested in or that you're looking at? Is there any networking or connections that you can make to me that you have found beneficial? Because at the end of the day, you're much more likely to get involved with somebody that somebody else makes a connection to versus just getting onto the computer and typing into Google, passive investing, Texas or something like that. I mean, that's really how I would get started.
It's a lot of networking and growing from there. Well, things are uncertain in our current market in terms of real estate investing, in terms of the geopolitical environment, a lot of things going on. What is your take on where we are today? And I know this is looking into your crystal ball, but where do you think things are going?
This is what I spend a lot of my time researching, listening to podcasts, going to conferences, getting on networking calls and talking about because it's so relevant. There's so much uncertainty. Things are not clear, right? The path before us is a little bit dislocated from what we're going through right now versus what I think we should be going through. So going forward, I really think that, there'll be recession second half of 23. I think that, there's, people say there's something going to break in the economy. And I don't know if that's going to be banking. I don't know if it's going to be pension funds, that have to market some of their losses. I don't know if it's the inverted bond yields that's going to send the Treasury to have to issue way more bonds. I don't know what it's going to be, but I feel like something's coming. However, in real estate, as long as you have a good basis with good debt and good management, I feel like we can ride this out. And we've done extensive stress tests on our debt and our NOI projections for a lot of our properties. And I feel like our portfolio is pretty well insulated. But I do feel like, look, people need food, clothing, and a place to live. The majority of our portfolio is multifamily. I follow a bunch of people, but in particular, Altos Research with a guy named Mike Simonson does a video at least once a week on the current inventory and housing prices and where we are with that. As of last week, we had 245,000 single family homes on the market. A normal, healthy market has about 1 million single family homes on the market. So we're still in a supply dearth, and I don't see that improving anytime soon. And that's because I think 60% of mortgages out there right now have a 4% or a sub 4% mortgage, and 20% of that has a sub 3% mortgage. About a third of all homes don't even have a mortgage on them, right? Free and clear. So by definition, to have a housing crisis, you need, really motivated sellers, people that are in trouble. And right now we're hovering, around the the same kind of foreclosure rate as we've always had. And there's just not a lot of supply coming on the market. With that being said, there's a lot of news reports about multifamily supply coming on. And people always ask me, well, doesn't that impact you? And yeah, I guess it does in some respect. But when people are building new multifamily, you got to think about palm trees, pools, beach, brand new Class A, concierge, marble countertops, $4,500 a month in rent. And that's not where I play, right? I play in the B and C space, which is more, affordable housing for workforce up to like a place that I would like to live in. So there's a lot of dynamics at play. I do think that the Fed, will have to lower interest rates. I don't think we're going back to zero interest rate policy right away, or ZERP as they like to call it. But I do think that there's right now there's 180 to 200 basis points in cuts by Q1 of next year. So with that being said, I think all the people that have, commercial loans that they need to roll over, if they can, survive until then, and their NOI is hitting pro forma, they'll be in good shape. So I have a lot more to say, but I'm going to stop there, Alan.
Well, Tim, it's just been wonderful having you today. Inspiring and informative. Thanks for being with us.
Thank you so much.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off passive real estate investments, then you'll want to immediately go to steedtalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to steedtalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.